Okay, so in today's market report, we're going to talk about why you should never, ever put 20% down when you're buying a home. Ever. Okay, so maybe it's not that dramatic, but we're going to talk about the pros and cons of not putting 20% down. And then at the end, we're going to try something new. And Kelly and I are going to reveal our opinion of should you put 20% down or should you not? And we don't know each other's
our own
opinion.
personal private opinions.
So we're going to see, do we agree with each other? Okay, so the general theory is that a lot of people are told and have the belief that they should save up their money to get to that 20% so they can avoid PMI.
PMI is? Private mortgage insurance.
I was going to say personal mortgage insurance. So that's when you put less than 20% down, right? Mm-hmm. And it basically helps protect the insurance company. So a lot of times when you're saving that money, the homes end up costing you more because they're appreciating. Let's say you save for 2 or 3 years. Well, those house prices rise more than what your PMI ends up costing you. So you end up losing money by following that strategy. Right. So we're going to look at the other pros and cons of this as we go through this. Okay, so you go with number one.
Okay, pro number one. You would have more money for repairs if you don't put 20% down.
Yeah,
right?
So let's say we're looking at a $500,000 house.
Yeah.
So 20% down would be $100,000. Mm-hmm. Okay. So let's say you put 5% down. Now you've only put down $25,000, so you have an extra $75,000. We're just going to go with that in this example. Yeah. So you have $75,000 towards future repairs.
And not to scare you, it's not like every house is a money pit and you need repairs, but you can also do these special little things that you walked into and said, "Say, I really want that bathtub in the bedroom because contrary to what you think, it's going to be a great idea."
We're talking about that. So you have that $75,000. You put additions on the house, or not additions, but upgrades in the house, and increase your home value.
And let's say you do have a repair, you have it for that too.
Yeah, and also reserves.
Yeah, that's number two.
Yeah,
reserves.
So just in case something comes up, like an HVAC breaks or the roof leaks or something.
Or say, I have a great example of what might come up. Okay, so we actually bought our house closed March 8th, 2022.
Yes. And
with all the increases in property values and everything, of course, the handy dandy tax assessments went up, and our escrow account balance was almost $11,000 short. So we either had to pay off this escrow shortage, or our monthly payment would have gone up by quite a lot.
So having those
just under
reserves.
$1,500 a month for a year. So luckily we had the reserves, and
and we had a stove that went out, $8,000 fix.
Right.
Having reserves is helpful. Not to scare you, this doesn't always happen, but
we bought an old house.
Yes, we did. So those are the pros. You have the money for repairs, money for reserves, and then also if you want to invest, in other real estate.
Yeah, that's the best investment.
Yeah, because you can use leverage in other investment properties, and we'll go into a whole other topic on that. Yeah. Or if you want to put it in stocks, if you think you can get a better return for whatever investment you want to go into. Then if that investment's going to be higher than what your appreciation would be if you had the money into the account, then you have that room.
Right. So yeah, very good.
Okay.
So let's talk about the cons. Obviously, you have PMI that you have to pay. It's a little added payment to your mortgage payment. It's less expensive the better your credit is, but it's there. However, it is only temporary. Right? So it's only until you get up to 20% equity in your home, and then you can have it recalculated and it can come off.
Yep. Unless it's FHA?
Yeah, not for FHA.
Yep.
I was going to get to that. That's forever and ever.
Yep.
So refinance into a conventional.
So you have the PMI. Second disadvantage is obviously because you're financing more than your mortgage payment. Outside of PMI, your actual mortgage payment will be higher. And then again, it's a matter of, is that extra $100, $200, whatever it is per month on the mortgage payment, is that enough to warrant putting an extra $75,000 in to save it? You just have to calculate those numbers.
Run the numbers.
Yeah, exactly.
Finally, your last con is it could weaken your offer. Could, right? It just doesn't look as strong when you're competing against all these other offers. If think about it, if you're selling the house and you have 5 offers come in, and one of them is 5% down and another one is 20% down or 25% down, you're going to think, this person's more serious. They have more going on for they're
a stronger buyer.
Right. Yeah. So you would be more likely to take a risk on them, assuming everything else is equal.
Yep.
The way you can get around that is?
Well, you can, if you have the cash and you're deciding not to use it towards the house, you can provide proof of funds with your offer.
Yeah.
And why this matters to the seller, and so this is the positive to the negative on the seller side, 20% doesn't, just putting down 20%, 25%, 50%, 5%, it doesn't matter to the seller as far as how much money they get.
Yeah. Theirs is the final sales price. That's all that matters
That's
to them.
all that matters. What does matter to them is the strength of the buyer. So if somebody comes in and they have a 5% down and they don't have cash reserves and the seller takes the property off the market for them, 2 weeks into this, if there's some hiccup with their DTI, debt to income ratio, that buyer may not qualify because they don't have that extra cash.
Because they know they might be right at the line.
Yeah, they're skating on that line. So that's why you want to, that's the only negative with regards to strength of an offer.
Yeah.
So if you don't have those cash reserves, that's just something you have to deal with.
Yeah.
We get clients under contract all the time with 5% down.
Right.
But it can be a hindrance in
Yeah,
multiple
even
offers.
if an appraisal is off by $3,000, right? If they know the buyer has the cash reserves, they don't have to nickel and dime.
Yep, exactly. Yeah.
And I know 3,000 isn't quite a nickel or a dime, but kind of it is.
It can be. It can be depending.
Yeah.
Yeah. Okay. So those are the pros and the cons. So what it comes down to is like, how does it work for you? So what is the final opinion? So I am going to graciously let Kelly go first and see what her opinion is on 20%. Go.
Okay, and you tell me if you're surprised or not.
Okay.
Always put as much down as possible.
I'm not surprised at all.
I don't know. My temperament is just to be safe and conservative. You do the all savings stuff, and then you lump it all into this one thing. Get your payments all comfy, cozy. Tuck them in bed every night with a little kiss and all this. There's no fear, right?
And Kelly looks at a personal home, as a savings account. So she's putting that money in. That money is now sitting there, and it's appreciating, and she's got an asset to back it up. So no, that doesn't surprise me. I expected you to say that.
Okay, and your opinion is?
Which one I'm surprised. So my opinion is it really depends. Okay, there's two situations. If you have no intention of investing the money, if you have $100,000 and you have no intention of putting that money anywhere else to earn earn revenue for you, you only intend to hold that money just in case, then I say you put it into the house.
Yeah, just go night-night in your savings.
Because the house is appreciating, you're earning interest, you're getting debt paid down, overall that money is going to make you money. But if you have an inclination to invest, whether it's in real estate, whether it's in stocks, it's something that's going to give you a return, I say stay as liquid as possible and put as little money in. From an investment perspective, when you buy an investment property, your goal is to put as little money into that property as possible because you calculate your return not on the value of the property, but on the value of the money you put in.
Right.
So for example, if you put $25,000 into a $500,000 house, and next year that house appreciates by 3%, you just got a $15,000 return on $25,000. That's like a 60% return. My math could be off. Versus if you put $100,000 in on that house, and you got a $15,000 appreciation, then you just earn 15%. So it's how much money can you earn on the dollar. So that's where it comes down to for me.
And then so to wrap that all up, it's to say, try to understand your own temperament and your relationship with money tolerance. And how you feel about it. So with that being said, Sean knows where I am, and I get all hot and bothered about the idea of not doing what I'm comfortable with. But this man is amazing at running numbers. So he always does this, and every single time he has maybe there was only one time that we ended up going with my comfort route, but all the other times when he runs the numbers and he'll do it for you.
Yeah, absolutely.
It makes sense, and I have not regretted it. As a matter of fact, fast forward 6 months, 18 months into certain situations, I'm like, that was really smart. But really good.
Yep, and it just all depends on your situation. So happy to run the numbers for you and see what works best for you guys.
Yeah.
Okay, so I think that's it. So let's get into the market report.
I love you, you're so great.
I love you too. All right, so on to the market report. We're going to look at the graphs, see what's been going on. What's your perception on the mood of the market?
We're finally getting a lot more houses on the market, it feels like. Right? We're getting some good stuff out there. But then
they're going quickly.
They're going so fast, and the contingencies and blah. I feel like I'm saying the same thing we said.
So as we go into the numbers, you're going to see the numbers haven't changed a whole lot as far as ratios with buyers to seller activity. Last week inventory was down a little bit, but the last couple of days we've had an influx of markets. We were shooting this on Saturday morning. Thursday we had a lot of properties come on the market. So we're going to see how that pans out, but we'll get into the numbers of what happened in the last 7 days and show you guys exactly what's going on.
And the face would be the resilient face, like okay, I'm not buying my forever home, but I'm
Yes.
going to buy my for now home because it's going to be a great savings account that I
Yes.
get to live in. Which is
Yes. Time in the market, not timing the market.
Whoop, whoop.
Okay.
Okay.
All right, guys, let's get to the numbers. Okay, so we're about to dive into the numbers here, and something really important to kind of point out is when Kelly and I were shooting the other part of this video, we had not yet looked at the actual graphs. So we do that intentionally when we discuss the mood of the market, because perception doesn't always equal reality. So that's why we use numbers, and that's why we use 7 days worth of numbers versus past month sales and so on, because we want to get the actual reality of what's happening in the market numerically, because numbers don't lie, emotions do. So the perception has been that we've had more properties out there, that buyers have had a few more options, like the inventory had increased. But as we get into these numbers, you're going to see that that's actually not the case. So just keep that in mind as we go through this process, because a lot of times we'll feel things about market or other things in life. We'll feel these things, but the numbers don't actually match that. So let's dive into what we got here. All right, so orange line, as always, is buyer activity, and blue line is going to be your inventory. And you can see the inventory decreased even more for the second week straight. It's still in an upward trajectory, but it has come down relatively in the last 2 weeks. Buyer activity as a response has had to come down relatively in the last 2 weeks because there's been less inventory. But the key here is this gap is getting bigger. Okay, so this gap is what indicates the strength of the seller's market. So if we go over to the seller's market, even though activity has been decreasing, inventory, because of the fact that it's going down more significantly than buyer activity, in other words, buyers are still buying up everything that's coming on the market, the actual strength of the seller's market has continued to increase over the last 2 weeks. So again, this is where we began. This was the beautiful time that we were telling you all about in the fall, where buyers actually had an opportunity to not compete, so on and so forth. We then began this upward climb, and since that upward climb, we have been in a steady movement towards the strength of the seller's market. So that is still continuing, and we're just seeing that the activity has slowed down just a little bit. So if you look at activity compared to this period here, activity is still on an upward trend. It's just the last 2 weeks, sellers haven't been putting properties on the market. We do have some properties coming on the market this next couple weeks. The feeling is, and I mentioned this previously, that yesterday, today's Saturday, Thursday, there were a lot of properties that hit the market. Haven't run the numbers yet for the week because we have to see how that averages out over 7 days, but it does seem like there were quite a few more properties that hit the market on Thursday. So we'll see if that pans out or turns out to be an increase in inventory, which will move that activity up higher. So we'll see how that plays out. But for now, we are still in a strong seller's market. Sellers, now is the time to get into the market. If you're waiting until June, if you're waiting until July, thinking the summer is going to be stronger, it may be, but it's strong right now. So now is the time to get in the market. From a buyer's perspective, prices are continuing to go up. So if you are holding off to think that the prices are going to come down, we've had buyers that have been sitting on the sideline now for about 2 years, and they've just watched the prices go up and up and up. So even if the prices, for those people that have been waiting for 2 years, for example, prices have appreciated over 10% in the last 2 years. So even if the market drops 2 or 3%, there's still a net loss for the people that have been waiting. So if you're waiting for the market to come down, that's probably not the best strategy, especially in this area. We have very low inventory. We have a very strong economy here. I just don't see that happening. So I would recommend that you strategically buy, maybe not buy your forever home, but you strategically buy to get in the market so you can take advantage of any appreciation that happens. All right, if you have any questions, please feel free to reach out to us. If you would, please like and subscribe to the channel. Help us get this market report out to as many people as possible. And we will see you on next week's report. Have a great week.